All right, good morning, everybody. The day that we've been waiting for all week, and it's finally here. Enough with the hurry up and wait. I do got to say, though, that theory or that thesis has held pretty good all week. On Monday, the idea was if we popped to the upside, sell into strength, and if we fell to the downside, buy into weakness. Now, that buy into weakness has been a little bit rough because we did continue to grind lower through most of the week, but each new low popped us back up, right? It wasn't just one big, massive sell-off bar. It was a continuous drip, drip, drip lower. So we're finally getting to the end of it. We got the PCE today, and that'll get us into next week. We're going to go into blackout mode with the Fed. That'll give Yellen a chance out to chip her teeth. And as for spot gamma, they didn't have the AM as usual, so I sent out the FM last night, and they did a pretty good job of reminding everybody that we have non-farm payrolls and CPI on the deck for the next week. And we might be 2 weeks out, really, if you think about it. This is only the 29th, but that's what we're looking forward to in the future, right? Is we're going to get through February 29th today with the CPE. Next week, we're going to start getting into ISM manufacturing. Beyond that, we're going to get into the non-farm payrolls and then core inflation CPI. So we have that to look forward to. Then, of course, we got the OPEX on the table too. So there's always something farther out. Those three are the biggest ones on the table after today. March 8th, March 12th, and then March 15th. Don't forget, also, we have FOMC, but I mean, honestly, who's going to forget FOMC? You can always just keep track of the Fed watch, see what the market is thinking about what the Fed will do. These aren't projections from the Fed. You can search like Fed dot plot. You should be able to find at least one blog post or video or article that discusses the Fed's last real hint, which was around December, when the Fed kind of projected and hinted at 3 rate cuts this year. They haven't changed that, by the way. It's still 3. Although with the data that we get today, they might revise that to 2. So, the market's really going to be paying attention to the numbers that we get today. On this Fed Watch tool, it shows you the next FOMC date, March 20, and then May 1st. The June is where they were pricing in the first cut. And as I told you earlier in the week, this is what you want to watch to see if they're unwinding this. And you can see that they unwound it back to 49. It was at 52. A month ago, there was an 11% chance of us getting a cut in June. Then it went into the 50s, and now they're backing it off a little bit. So the idea that we're going to stay at our current rate, 525. A month ago, there was no chance that we would stay at this rate. Now we're at a 41% chance it's up. That continues to rise. So what we're looking at here is this bar is going down and this bar is going up. We want to continue to watch that to see if that's what we continue to get. But we also want to look farther out. If they're saying we're not going to get a rate cut now in June, if that's what the market is projecting, then where are they now thinking that we're going to get a rate cut? Start looking farther out. The probabilities of a rate cut in July are up, 2 basis points. It's not, it's not very extreme, but that's where they're pushing. So they're looking at July now. September is more elevated. They put in a 6% change there. And November. So they're pushing it out, right? This is a headwind to the market. These are gentle. They've already unwound a lot of it. So it's not, like we're going to sell off. And with everything else going on in the backdrop, the fact that we're even holding these levels is impressive, right? So it's just a headwind. It's a weight the market has to carry while it still wants to try to go higher. So it's not, we're not saying it can't go higher, just that it's going to struggle to do that. Looking at what's going on around the world, Hong Kong is still down. So your China ADRs, Alibaba disappointed. Markets didn't like that. There's still this entire situation with, the whispers of the great financial crisis and a housing crisis are starting to surface. And I was busy all day yesterday. I didn't get a chance to dig into anything, but this shocking change in the numbers really needs to be addressed. So I need more time over the weekend. I'm going to dig through it and see what's going on. But from some of the numbers that I've seen, it's impressive in its scope. So I don't know, one issue at a time, one brick in the wall of worry. Hong Kong's down. Even with all the stimulus that they throw at the market, they still can't get anything going over there. And there's now more discussions about EV restrictions, more restrictions on China. A lot of the automakers were raising their voice about cheap EVs coming out of China into the US. Some of those EVs from Chinese factories in Mexico just coming across the border. And their fear, of course, is that they're going to flood the US markets with brand new cars that cost $10,000 as opposed to brand new Ford and Chevy cars that cost $20,000, $30,000, and $40,000. More restrictions on China just really isn't going to help China out all that much. Behind that, we got Japan. A lot more whispers out of Japan that they are going to end this regime of yield control that they've been running almost as a global experiment for a long time, although I'm sure they don't like people referring to their monetary policy as an experiment. They're really indicating that this might end. And with the new governor in place, it might be a part of that change that is on the table. This is an impact on the scale of like Europe with Brexit. I mean, it's a really big deal. And the ramifications of it, just like with Brexit, are going to be vast. They're going to spread around the world, and there's going to be, ramifications that none of us even thought of until afterwards when we look back and say, yeah, that was probably pretty obvious. We should have seen that. It's a really big deal. So, when it comes to bricks in the wall, that's a pretty big brick because we don't know everything that's going to affect. The Dow down, about 1/4%. It's the one down the most out of the US, with the small caps this morning up the most in the US with 1/4%, and Europe just a little beyond that. We're still in that hurry up and wait mode though, so any of these can change after we get data this morning. And if the numbers come in hot the way that everybody's been talking about, then the market's going to try to reprice that rate cut, pushing it out even farther. And we could see some volatility this morning, which means, again, another chance for a liquidity gap opportunity. We didn't get one yesterday. It was almost a dud. And I've talked about that before. When they hype up an event and talk about, oh, this is going to be huge, the move that we're going to get is astronomical. Watch, it's going to push 80 basis points, and everybody hedges it to its eyeballs, then it doesn't really have any room to move. We get the data print, we get a little blip in the radar, and price goes right back to where it was. So this data point today is big enough that we should see them hedging if they're worried. And we'll get the print. We might get the opportunity for a liquidity gap play, maybe. Later in the day, we've got a lot of Fed speakers, and they're all just trying to get their word in before they go into blackout mode. And so far, they're all singing from the same hymn book. They're not overly anxious about cutting, but they're not really concerned that inflation's going to come back. They're more just holding the line because they can hold the line. They think the U.S. economy is strong enough that it can withstand these higher elevations. They think they found the sweet spot, and until they break something, They don't see any reason to cut. So if we go over to FX Street, we can see the ranking that they have for today. A lot of the different core PCE stuff. It's forecast to rise 0.4% on a monthly basis. And it's rising at a stronger pace than the previous increase of 0.2% from December. So not only is it rising, but it's rising faster, the rate of change. And that's one thing that's getting a lot of people's attention. Throughout the night tonight and into tomorrow, it's going to be a lot about Europe. So that's something to think about. If you're holding on to something through the end of the day today and you're thinking, well, we're done with all the stuff. PCE was the worst one. The hurry up and wait is over. I can take a swing. Yeah, okay. Just keep in mind, Europe is going to be coming out with data tonight, and their data in the overnight tonight can most definitely change the course of everything. So some really big economic data prints coming out in the overnight tonight. As I've mentioned before, Finance Juice does these nice little write-ups. Europe's not closed yet, but they give us an early market wrap for Europe anyways, because they know enough US people are getting ready for the day that we want this, even though Europe isn't closed yet. Usually they do a market wrap after the market closes. So they do one on Asia, Europe, the US, and you can go get these after the trading day. So when our day is done, you can come back to Finance Juice and see what they talked about for what moved markets today. This is really helpful when you're trying to figure out why price did something, say spiked to the upside or dropped down real hard through the trading day, and you didn't see any kind of news that made that happen. When you're looking around, this is a really good place to go look, see if they talk about it in their wrap. After this, they're also going to come out with a pre-market kind of briefing. So that's worth taking a look at too. You can see it's not like you got to read a book. One or two paragraphs, you're done. Same thing with the briefing. One or two paragraphs, they'll highlight a few key things and you're good. I can't tell you how many times I see someone say, what was that big move? What happened? Like you didn't know 8:30 we had data? Oh, I didn't know. If you're day trading, you better know. It's free. It doesn't cost you anything to come and look. Eight, 8:30, 9:45, 10, 10:30, 11, 11:30, 3 o'clock, and mixed through all of that is Fed speakers. So it's a really busy day in the market. It's going to be hard to see one particular directional bias. So even if things are very strong and bullish or very strong and bearish, how do we keep that bias all day long if we're going to continue to get data that might contradict the original data that put us in that bearish posture or bullish posture? So it's really just something to kind of keep your eye on today, that all day long today, we're going to continue to get economic data coming in, and any of it could take away whatever directional bias we have. So it could just be a very violent, choppy day that might look a lot like the previous few days that we've had. Right? Yesterday wasn't exactly, a really great trading day, other than that beautiful double top. I say double top, but anybody who's heard me long enough knows if I'm thinking it's a double top, it needs to overshoot, right? It needs to have gone higher than that previous high. So not my kind of double top. Still, that was about the best move of the day. Other than that one, yeah, my line drawing sucks, but there is that one. That was a really classic double bottom yesterday. It overshoot just the way it's supposed to overshoot, and it stopped right where it was supposed to stop. That was the best one yesterday out of all of them. So there was at least something to play, but otherwise everything in the middle was just a bunch of trash for me. I was too busy to get any of it anyway, so it doesn't hurt my feelings that I didn't get any. You can see this liquidity bar. This is exactly what we're going to be trying to focus on today. When we get the 8:30 data, if we get a big bar like that. So we got one earlier from the kill zone. That's the start of it all. If you're even remotely concerned, you can drop down to a smaller time frame and see if it started one candle sooner. If it really matters, if you're trying to play the gap close, you would want to go to a different time frame and find where it started. Was it really that first candle or was it that one? I think it was the 2 o'clock kill zone candle, the big one here. The idea would be that we would expect price to go up to that. The fact that it didn't is very likely the halfback. It got tangled up there and it's just stuck. I say stuck, but look at it from a different point of view. The market is happy right there. It's balanced. There's a whole lot of trading going on, quote. And everybody's just very comfortable under VWAP, no less, to make their transactions right there, both sides. So what happens? We build up liquidity on both ends. This is what we call a draw. Draws the market in. Anybody short's got their orders across the highs. Anybody long's got their orders across the lows for their exits. And it just draws in more and more players until finally we get our break out of it. So we want this kind of candle, all right? This is what we're expecting. If we don't get it, it's not a big deal. Just like yesterday, we were expecting to get one and we didn't. It was just a little bit of a dud. There wasn't much of a gap close play then either. You can see they're not hedging this morning. So if they are concerned about the data that's going to be coming in today, we can't tell it. We're not seeing it. And you can keep your eye on it, depending on the broker that you use. Keep your eye on this front number. It's a little elevated this morning. If that front number gets higher than the next number out, that's what we call a market maker move, MMM. On this platform, you'll see an MMM show up right there, and it'll calculate the difference between those two, and it'll give us some numbers on how much farther the expected move could be today. Until that happens, then we don't have any clear signals of hedging, and we'll need to wait. So someone just asked about the double top and why it needs to go farther. Think about it for a moment like this. If this is price and it's hit the range, it's hit the range, we'll even do a triple top this time. It comes through, that's a bullish signal. We get the bulls in there, we trap them, and then we dump it. Perfect. If we don't trap the bulls and it just does that, well, that kind of forms us into a cup and handle. So for me, if it's a matching top, I don't look bearish, I look bullish. If it's not a matching top and it overshoots first so that we can trap the bulls, that's what it's supposed to do. So you can find double tops and double bottoms where it doesn't overshoot and it works out anyways. But to me, those are just sloppy double tops and sloppy double bottoms that happen to have worked out anyways. They're not the preferred trade. I would rather have it do what it's supposed to do, which is overshoot and be the trap that it's supposed to be. It doesn't trap a bull if we never broke out in the beginning, right? Just like back here. There was the high. We came back up. We didn't just stop at that high. We overshot the high to trap all the bulls first. Then we went down. That's a double top the way it's supposed to be, as far as I'm concerned. If it had come up and just touched the line, which is what new traders think pivots are supposed to be, is a place to stop price, liquidity resides on the other side of the line. So if we just come up and hit the line and fall away, we never got into the liquidity. We also didn't get to trap all the bulls. It can't be a trap if we don't at least pretend to make it look like we're breaking out. Same thing with a double bottom. Double bottom is a bear trap. Well, it's not much of a trap if we don't expand beyond the bottom of the previous pivot point to lure the bears and make them think we're actually breaking down. And liquidity resides on the other side of the pivot. So price is not supposed to just come down and bounce on the line and go. Because liquidity's on the other side, it needs to go through that line. Then we trap the bears, squeeze them until their heads pop, make them puke. So again, you can find examples where it doesn't overshoot and it bounces on the line just perfectly. But when I was new, that's what I used to look for. And that's what I thought price was supposed to do. And I would get frustrated when it would overshoot like this. And I would think, what's going on here? What's wrong with this idea? William O'Neill and Investors Business Daily is the one that really started to turn my head around on these, where I quit thinking about the perfect bounce right on the line and instead started thinking about what the entire concept of that pattern was supposed to be. It's designed as a trap. Then you start getting into supply and demand and liquidity, and you start learning about where's all the liquidity on the other side of the pivot. It makes perfect sense when you marry those two concepts together. The price pattern being the trap, and then the liquidity being, quote, the reason for us to go to the other side of the pivot. Volume is pretty good, sitting at 107, showing, we do have active participants in here, so they're not sitting out, they're not hedging. It seems like they're not overly concerned at first blush. We did already get a really good move through the kill zone, and that might be part of it. But we're holding in that zone right now. So at this point, I think we just need to get the other side of this data print and move on from there. The put wall is still a long ways out. It was the first thing that I did this morning is came in and checked where that put wall is. It's all the way down here. All the way down here at 45, and they didn't move it. That was one of the tells that I was looking for. I nearly ran into the office this morning looking to see, did they roll that put wall up? Nope. Still in the same spot. So we're underneath the volatility trigger. We're underneath our own daily pivot point. We're still holding within last week's range. And we are almost back to the weekly pivot point. Generically speaking, when we're above the weekly pivot, we're bullish. And when we're below the weekly pivot, we're bearish. We want to look for bearish opportunities, or we want to look for bullish opportunities. When the market's falling all week, it doesn't really offer a lot of bullish opportunities. And the bias that I spoke about earlier, sell the highs, buy the lows, buy into weakness, sell into strength. That was the plan since Monday, since the Monday morning briefing. That we were going to hold the line, stay in a range, and wait for data today. And I had a number of people say yesterday, I don't feel like we're in a range. I mean, I can kind of give you that. If we're looking at the ES, we start going over to, some of the other indexes, we can just draw a line across, right? Between Tuesday and Wednesday, Wednesday's price stayed almost entirely inside of Tuesday's price. So when you look at it on a daily chart, if the entire day of Wednesday is sitting inside of Tuesday, we didn't go anywhere. And if we didn't go anywhere, then we must be range bound. Now, the difference between Monday and Tuesday is a little bit of that decline, right? That whole idea of buy into weakness. I wasn't too prescient on Monday because we did just continue to grind lower and lower and lower Monday. But we settled out into it into Tuesday into Wednesday, and now here we are on Thursday, still sitting inside Wednesday's price, which was sitting inside of Tuesday's price. We're still just sitting in a range. $50.61 is one of the halfback measures. We nailed it. Maybe overshot it by a tick or two, but that's pretty darn close. The next one down is $50.41. So it's a long ways off for the next level off, next level down. We're back to the 10. So if we're looking for a nice clean reset and a continuation move, then we would expect to deflect off of that 10 perfectly. The thing though is the S&P has shown a lot that the 10 is good for a visual cue. Are we riding above it? Are we too far away from it? But it is not any sort of support. So the same thing here. When we overshot the 10, kind of got a long ways away from it. It made sense that we were going to stall out, maybe even gently fade back and give that 10 time to catch up. Well, it has caught up. So we're going to look to maybe get a little bit deeper of a pullback, which gives the market some energy, or we're going to see it use the energy that it's already made and continue this leg up. This is like a micro TRB setup. So we could see some basing here and then a retest of the high and a continuation. The 50.61 is the halfback of this one big large day from the 22nd. The other halfback is the entire week. $10-day, 30-minute volume profile. And golly gee, look at that. The point of control is up here with price. We still don't have a classic shape. This is just a muddy mess. There's no D or B, P, nothing. This is just chaos. We do have a shallow area, but so far we've resisted falling through it, which is odd. It's very likely that an alternate market that we correlate with hit some sort of support or resistance and stopped us from falling here. Either way, the idea would be generally that we move through shallow areas relatively easy. It's very likely if we break our own low here this morning, that 50-60, then we can go to 50-40, which is the weekly halfback, get us right around that zone. Around there. As long as we continue to stay where we're at, we're going to build more structure at this 50-76. So it makes sense that it will become a stronger and stronger resistance because it is over our head. The thing is, when it comes to trading activity like this, we really don't want to consider it as a resistance or support if it was below us. It's an area of interest where the greatest amount of trades took place. How many of those trades were buyer's remorse or seller's remorse? Either way. And that if given the opportunity, some of those trades would be unwound, or that they like what's going on so far and they're going to add more to it. If it was the greatest amount of trading at that spot, the expectation is we're going to get a lot more selling if we get back to that spot. That trading could be selling, could be buying. We just know it's going to very likely be a lot more trading. So you can call it support and resistance, but just focusing on it as an area of interest and looking for signals or clues that it is a lot of trading going on there and whether or not it's buying or selling. Using the CD, the cumulative delta, using the candle patterns that you see, watching the dome for pulling and stacking, and then just, the trades afterwards. Looking at a smaller time frame volume profile to really hone in and respond to this area. With the speed and the depth of the move through here, it's very likely that should we begin to actually break this half back, this 50% mark, that we can unwind this move a lot easier. I'm not a big fan of that in the current climate with all those pivot points that are below us, but it's absolutely possible. I think if it was that easy for the market to unwind that big candle day, we already would have if it was that easy. And even with the put wall so far away, there's so many other things that are near us and so many other markets that are still really strong that I think if it was gonna, it would have. So without the data, without something negative today to break this low and really force us to go lower, I think we're just going to hold the line, come right back up, test the highs, and continue to go higher. It's all on the data, though. If the data is negative, then obviously we're not going to go higher. It's pretty easy to figure out. So we carried that point of control through the day yesterday, and I had mentioned I would leave it on there just until today so that we could look back and see, did price respond to it at any other point in the day yesterday? And would it have been worth keeping on the chart? So it was around 7:30 when I left it on. We were having this conversation yesterday, right about 8 o'clock. So it looked like this. And at some point, we ran up and hit it. And then we ran up and hit it again. Was that what stopped price? I wouldn't say that, right? No, I wouldn't consider it a resistance. I think it's more of a coincidence that we can point to it and say, wow, man, that did a really good job. But without that visual, without knowing that there even was a POC there yesterday, maybe traders would have been trying to go long here, thinking that there really wasn't anything in their path, any reason to not go long, and maybe would have tried to trade these breakouts. So at the very least, the visual would have been a warning, right? Maybe a little bit of a heads up to stop you from trying to go long right into a resistance zone or something that did resist price. We finally broke through it. Eventually, if you think of that point of control as a place where the greatest amount of trades took place the previous day, same thing we were just talking about, that's what it represents, the place where the most trades happened. The idea is that if we get back to that spot, there's very likely going to be a little bit of trader's remorse and some unfinished business, which is the words that I like to use. And then we could see more trading at that spot, whether that becomes a resistance or not. Depends on whether, resistance is always a look back. But at least you're aware of the line. So we don't have a BPOC from yesterday. You can see we've already crossed through it twice today. And again, if you wanted to carry it forward, well, that's what the books tell you to do. Carry forward the value area high, the value area low, and the point of control. I don't. I've already got enough pivot points that I don't need more. I only carry it forward if it hasn't been hit yet. And you can see we crossed through it to the upside around 7:30 last night, and we crossed back down through it around 3 o'clock this morning. So we've hit it twice. I don't need it. I'm going to take it off. We still have a few, one overhead here and some way down here. There they are. So we still got a number of them. And these haven't been hit yet. But we don't need one from yesterday. There's no reason to carry it forward for me. Right now, we're just on watch. Just like with yesterday, there's really no reason to dig into what's going on what's up and what's down. Because until we get the data print, anything that might be up can very easily flip to the downside and vice versa. Just at a glance, the fangs are down more than 1.5. Nat gas, semiconductors, bonds. So those are all down. And to the upside, oh, gee, wow, Bitcoin is still up. Oddly enough, the China ADRs are up this morning, even with China down this morning. So we see KWEB, but emerging markets isn't up. So maybe a little discrepancy there. So until we get the data print, there's really no reason to dig down too deep into the equities. You're going to want to do that after we get the data print, which is kind of what the whole point of the morning briefing is, right? To show you the steps to do this so that at some point you can do it on your own. You're going to want to go in there and look at that list after the data print, probably closer to around 9 o'clock because you need time for that data print to actually move some of these, and see which of these sectors and which industries are up or are down. And that will give you that idea of where to focus your attention. At the moment, Bitcoin continues to be. And if you're trading futures, there is on probably all the futures brokers out there, there's futures for Bitcoin. There's like 4 different sizes. So you can get the Bitcoin and then the mini, the micro, and the nano. And it's crazy super small. The nano risks like 5 cents per tick. Serious, 5 cents. So if you're newer to trading, you know, and you're on paper, but you're itching to go live with something that risks 5 cents per tick. That way, hey, wow, you're trading in a live account, but it's so small, it won't hurt you, right? I was showing someone a 10 lot trade the other day. We were trading the 10 lot of the nanos, and the margin requirement for a 10 lot trade was like $150. So you can do it in a small account, right? Obviously, you're not going to make a lot of money trading something that pays you 5 ticks at a time. It's not about making money or 5 pennies per tick. It's just about making that transition from paper to live a little bit, right? For you newer traders that are itching to try it out. The symbol on your futures platform would be, I think it's BIT. Yeah. Thinkorswim shows it right there. It just won't let me click it. The Nano Bitcoin. See, Thinkorswim won't do it. But if you're on Trade-of-8, TradingView, yeah, you can trade it there. We're at 63,000. I mean, Bitcoin just continues to drive up. If you're looking for, you know, the big short, look at this thing, right? At some point, it's going to be a great short, but until then, it's a great thing to trade. And look, I'm showing you the nano, but there's a mini and a micro Bitcoin too. So if you're trading futures, especially if you're using one of those prop accounts, did you see oil yesterday? While some of us were struggling with the ES and the NASDAQ and saying this is kind of a junky day to trade, not in oil, it wasn't. Oil was a really nice trade opportunity yesterday. Look at that. How's that for some trading opportunity? Lots of movement, good clean candles, nice price action. So especially if you're using one of those prop accounts, look at oil, look at gold, look at the ES, the NASDAQ, Bitcoin. Trade whichever one's got the better chart today. There's no reason to struggle on one single name if you don't have to. So with the US dollar Japan or the Japan issue, just keep your eye on like 151, We don't even want to get into that 150 area, let alone get beyond it. So the big drop that we saw yesterday, it was kind of welcome. I guess that was last night. But we don't want it to unwind. So this is a good start, kind of eased some fears, so to speak. But let's see if the halfback holds on that. If it doesn't, then we want to start watching this a lot more closely. Yeah, 150 and a quarter-ish. I didn't get it perfectly on the line, but that's pretty close. And with this going up, we should see the dollar index and the 10-year both going up. We had a little divergence the other day where the dollar was going down and the 10-year was going up. They weren't playing well together. So we got the 10-year this morning kind of acting the way it's supposed to, dollar too. So let's keep those in sync. If they don't stay in sync, then at least it's a warning. Kind of gives you a reason to reduce the contract size that you're using in your day trades, maybe take profits a little bit sooner. Notice there are some pretty aggressive moves, all things considered, off of the bottom here. And with their move up, we're not seeing the S&P and the NASDAQ drop. So it's not this inverse correlated market where the Dixie goes up and the ES falls down. That's not what we have. It's more of a line in the sand. If we get above this high in the dollar here from yesterday or last night, that 104 and a quarter, we could start to see impact in the S&P and the NASDAQ. Same thing with the 10-year above, say, 4.33. So instead of just, oh, it's going up, we should see these two going down. Think of levels. I like that swag, right? Swag levels. SWAG, swag. Scientific, wild, fill in the A word, guess. Yeah. Yeah. That's it. Otherwise, we're waiting on data. Everybody be careful. Be safe. I'll see you all tomorrow.